Hello everybody. So today I want to focus on the Mac 5. I have updated my valuation spreadsheet with the latest number for all 5 of these stocks: Nvidia, Amazon, Meta, Google, Microsoft. Of course, Nvidia reports in about 20 days, but Amazon, Meta, Google, and Microsoft have all reported their fresh numbers yesterday. And the market is trying to make sense of it all in a typical market fashion. It erases, hundreds of billions of dollars from a few stocks and add hundreds of billions of dollars from a few other stocks, as if that made it any sense. And of course, Amazon is not really moving too much. Of course, these companies have not become 200 billion or minus 200 billion valuable today, right? It just doesn't work like that. It's all theoretical. No, the better question, of course, is what's going on as far as the valuation, as far as the numbers, which is the relative better buy in the Mac 5, which one is relatively more interesting. And that's gonna be what I try to talk about in this video. So first of all, my commentary on Nvidia. Nvidia, of course, has not reported earnings yet, but I have no idea. At one point, Nvidia down nearly 5% today. I have no idea why, because whether it is Meta, Google, Microsoft, or Amazon, they all reported that they're going to spend a fortune on Nvidia equipment. They're all raising their capex. I think the capex now is going to be something like more than 700 billion of spend on Nvidia that the hyperscalers have announced over the next few years. 700 billion plus. And for some reason, Nvidia is down. It makes absolutely no sense. Let me talk about Nvidia a second. Yes, it's up 84%, but revenue growth next 12 months is predicted to be 55%. That's likely going to be much more than that. Jensen said they have $1 trillion in revenue visibility. And whether it's over 5 quarters or 4 quarters or 6 quarters, people debate. But he did talk about that visibility of $1 trillion in revenue. Insane visibility. The stock is up in line with the top line growth. I don't think Nvidia is the most interesting valuation out of all of these stocks, but it's definitely not expensive in my view. Keep in mind, this stock was stuck at $180 for the longest time. It finally moved a little bit at 200 right now. And that's good. But, if you look at the NVIDIA chart, the performance of NVIDIA, it's the yellow right here. The performance of NVIDIA, has been slightly up the past month, but otherwise it's been flat like 7 or 8 months out of last year. And so in my view, it's a well-warranted rise. I think NVIDIA is rising, in a way that makes sense. Nvidia is essentially one of these rare stocks that makes sense as far as the price movement goes. So I like to see that. Now, moving on to another stock I want to talk about is Google, in contrast with Nvidia. Google, I now find too expensive. Google went up 128% compared to 52 weeks ago. Google is the blue right here in this chart. Google has gone parabolic. It makes very little sense to me why Google is becoming so expensive, especially when, if you want to talk about the winner of the AI race, seems to be Anthropic. Amazon likely has a much big, not likely, for sure has the biggest exposure to Anthropic, and not Google. I think the market is getting excited about Google's GCP money, right? And the cloud growing fast for Google. The cloud for Google actually seems to be growing faster than for Microsoft and for Amazon. And a lot of people are very excited by Google's also the TPU product. Lots of excitement around Google. But to me, 128%, it's gone too far, too fast. And most important, on my spreadsheet, EV over GP over RG, enterprise value, over gross profit over revenue growth, is a 1.1 for Google. And so that's way too high. I consider anything above a 0.5 to be on the more expensive side. Nvidia, granted, is slightly above that, but Nvidia has a rule of 40 of 117, right? Google has a rule of 40 of 53. By the way, they're all amazing companies. I mean, they're all absolutely amazing companies. Look at EBITDA margins for all of them, right? Absolutely outstanding. But I think Google has run too far, too fast, right? And I think it needs to take a breather. Amazon. Let's talk about Amazon. Amazon, of course, is a powerhouse. Now, Amazon is only showing top-line growth at 12%. But why is that? Because they have nearly $750 billion in revenue. $750 billion in revenue. Think about the power that a company like Amazon has. It can direct that revenue towards whatever goods it wants to sell. Amazon is a leading company, but unfortunately, in the typical Amazon fashion, not unfortunately, fortunately, I love that. I love that they do that. But as far as my spreadsheet goes, Amazon is a reinvestment machine. It's a compounding machine. They reinvest like crazy all the time, always, which is why the EBITDA margin is quote unquote only showing 20%, and it doesn't look good in the rule of 40. It looks okay on EV over GP over RG, given that you look at Nvidia, you look at Amazon, right? These are exceptional companies. And so I'm willing to see it slightly above a 0.5 on EV over GP over RG, given that these are outstanding businesses. But Amazon doesn't look the most compelling on that spreadsheet, although, in my view, it looks much better than Google, for example, because it hasn't run nearly as much and because of its Anthropic stake. But as you know on this channel, I made 2 videos about this. My exposure to Anthropic is through Zoom. Zoom's valuation can be mostly explained by Anthropic. Especially, I need to make another video, by the way, on that, because a lot of people are saying Anthropic is worth actually $1 trillion, which if Anthropic is worth $1 trillion, then Zoom is way too cheap. Like Zoom's valuation can be entirely explained with Anthropic. There's another Korean company that has pure exposure to Anthropic. But Amazon has a huge exposure to Anthropic. So again, I like it. I think it's cheap, but I also think in my spreadsheet it's not advantage. Now, before I go to the winner, I'll keep the winner for last. And looking at the numbers, you can guess who I'm going to say the winner is. Let me talk briefly about Microsoft. Microsoft today is down 5%. And Microsoft hasn't been doing well because Microsoft has been impacted by the SaaS apocalypse, as they call it. Even though Amazon is not a SaaS business per se, it's got a big SaaS-like components, right? Microsoft Teams, Microsoft Office, trying to, get $10 a month from a software that they used to sell for like $59 10 years ago. Now they charge you, $10 a month for just barely 2 gigabytes in the cloud or something like that. Amazon has turned into this subscription, this very large subscription business. Amazon is core to so many companies. It's very tough for companies to rip out and remove Amazon. But, I think the stock is slightly down. Today, news circulating that, Mythos from Anthropic might actually threaten some of the security on Microsoft. Interesting, right? But also, we have a lot of people who are seriously thinking about trying to disrupt Microsoft, including MacroHard, right? Elon Musk's XAI venture, which started out as a joke, but didn't really paint that on a building, right? MacroHard. It's true. Software could be generated by AI in real time, and if software is generated by AI in real time, then what's the value of PowerPoint, for example, right? And we saw that, of course, with Cloud Design and the impact that it had on Figma stock. I do believe some parts of the Microsoft business, the software part of the Microsoft business, actually could be threatened. Now, when it comes to the hardware part of the business, right, all of the hyperscaler part, Azure, Microsoft Azure, the cloud, I think they're on solid footing. I think they're on solid ground on that part of the business. But if you look at the number, EV over GP over RG is not looking good. At a 0.86, it is not looking good for a business which is arguably lesser quality than Nvidia and lesser quality than Amazon. Arguably, right? To me, Microsoft is a company that has rested on its laurels for far too long. Great rent seeker, perhaps the best rent seeker of them all. The best rent seeker of them all. I'll give them kudos to that. The rent seeking has been stunning at Microsoft, right? How many people actually hate Microsoft with passion? They dislike the product, but they keep paying for the product because they're stuck with the product. That's such good rent seeking, right? Think about the old joke of people, complaining because their company got out of Zoom forces them to use Microsoft Teams. Very few people, or Slack. Slack was the same story. How many people don't want to use Microsoft Teams, but were forced to use it? Forced to use it. That's rent seeking for you, and they're really, really good at it. They're the best at value extraction. But to me, it's expensive. At a 0.86, it's priced in. Let me conclude with the stock that I think is the clear winner of this, provided that you're interested in buying a big tech stock, which, the performance of the underlying stocks of these big five has been pretty good because it benefits from the flows of money, right? As the money supplies gets printed, you have a lot of buying pressure that sticks to these stocks because they are so high up in the indices. So that gives them a volatility that makes them less prone to manipulation. That's why a lot of people like these stocks. But it's also why it's ever more important to buy them cheap. And to me, I look at a company like Meta, I find it pretty cheap. So first of all, Meta is only up 11%. Year to date, 52 weeks, only up 11%, right? So Microsoft is even more of a laggard, but roughly the same as far as I'm concerned. They essentially haven't run compared to Google, compared to Nvidia. They essentially haven't run. But when I look at the valuation of Meta, I see 22% forward revenue growth. Gross profit is excellent. EBITDA margin 51%. Rule of 40 is a 73, just like Microsoft. But it's more than twice as cheap as Microsoft. It's more than twice as cheap as Microsoft. It's nearly a third, not quite, but nearly a third cheaper than Nvidia on EV over GP over RG. And it arguably has a business that is harder to disrupt because the business of Meta is networks. It's all about the network effects. Doesn't matter if there's a better social media out there. If your friends are all on Facebook or on Instagram or on WhatsApp, you're going to stick with Facebook, Instagram, or WhatsApp because that's where your friends are. And you don't go use Instagram because you love the product. You go use Instagram because all of your buddies are on there and you share whatever, vacation pictures or whatever. That's the reason why, right? And so, of course, you have TikTok, and TikTok is taking market share. But I would argue if you follow the social media world, Meta has done a good job at introducing these videos, these super addictive videos, and YouTube too has done a good job in introducing these super addictive videos everywhere. These addictive videos are everywhere now, so they're really not a hallmark of TikTok anymore because these videos are everywhere. So what I'm trying to say is I think in many ways the moat around Meta is stronger than, say, the moat around a Microsoft because you could have an AI design operating system. Like you could totally have an AI design operating system. Now, whether people are going to make a switch or not, that's another question. But you could have that, right? Microsoft has a lot of software that could be disrupted. Meta is not. I mean, it's a big tech company, but it's not quote unquote software per se. The value of Meta is in those links between people, those relationships between people. People use Meta not because they love it. They use Meta because everybody else uses Meta. Just because you may learn English, not because you love Shakespeare, you learn English because everybody else speaks and learn English, right? That's the network effect. And so I think from that standpoint, I find it quite interesting. Couple that with the fact that it's down 9% today, and it hasn't run nearly as much as everybody else. I like it. I like it quite a bit. A lot of people complain about, of course, the capital destruction with the metaverse and the money that was spent there. But we'll see. It could have worked. The metaverse could have worked, right? It's like, when you look at the past, your vision is always 2020. But back then, that was a credible move. Now vision is 2020. That was a bad move. They wasted money. They lost money. Okay. Well, Zuck is going all in on AI now. I think AI is a less risky bet. Betting on AI is, I think, a stronger bet than betting on the metaverse, And remember, all this AI, I happen to believe advertising is moving fully AI. I happen to believe one social media addict, one custom ad per social media lover. and think about how much AI you're going to need there. Think about how much more efficient the algo at Meta is going to become. So I like the valuation of Meta quite a bit right here. And I think if I were interested in a Mac 7 right now, in adding to a Mac 7 right now, if I were interested in doing that, I think Meta would be interesting. Now, of course, I love Nvidia on this channel, right? Nvidia makes a lot of sense because all of the capex is going to flow to Nvidia. All of the capex. And I know AMD is super hot right now, but AMD's run pretty darn fast, hasn't it? Pretty darn fast. So time for AMD to take a breather, actually, I think. Anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching. And have a wonderful, wonderful day.